Good evening, participants of the stock pitch competition. Welcome to another session of the training for the stock pitch competition. Today, as I said in the last training, we're going to look at valuation models. And technically, this should be the last of all the trainings, okay? Because this is the stage where you make your final decision whether it's a buy, is a sell, or investor should hold on onto it. So we'll go straight to the details of the valuation models. Take note that these are basic approach that we would want you to use. There are more technical ways of valuing companies. So this is supposed to give you the springboard, so to speak, to enable you understand valuation models as you continue your journey in finance. So this approach is the most simplest of all. However, if you don't understand, you can let me know so that I can go over it for you. Okay. All right. So the first statement I'll make is that you have to remember that valuation is both an art and a science. And different analysts may arrive at slightly different valuations. Be prepared to defend your analysis and assumptions during the stock pitch competition. Okay, so if Kwesi gets 2.5 and you have 3, it doesn't mean that you are wrong. Approaches are different. As you can see here, it's a science, it's an art. Your job is to defend what you have done or the analysis that you have conducted. All right, so the first approach that we'll talk about is a discounted cash flow analysis. A discounted cash flow analysis, popularly known as DCF analysis, dives into a company's cash flow to arrive at intrinsic value. When you say intrinsic value, you mean the fair value. You mean the price at which the analysts think the company should sell or should be bought at. Okay, and there are 3 steps involved. Number 1, you estimate the future cash flows. Number 2, you calculate the present value of the future cash flows. Number 3, analyze the present value to obtain your intrinsic value. We are not going into the detail of this approach, okay? The second and the third, we're going to look at those in detail. This is quite technical, it's a bit technical, and the intention of the stock pitch is not to confuse anybody. We want to introduce everybody into the field of finance and analysis, investment analysis, and so on. So we'll not go into detail of this one. So the second approach, the second way to work out intrinsic value is by applying a financial metric, like the price to earning ratio. In this case, where R is the expected earnings growth rate. So this is the formula: intrinsic value, earnings per share times 1 plus the growth rate of the earnings per share times the PE ratio. I'm going to go into detail. Don't panic. I'm going to break it down for everybody to understand. So here's what each component means. So earnings per share. When you say earnings per share, as per this formula, this is the amount of profit a company generates for each outstanding share of its stock. It is calculated as total earnings, as a profit, divided by the number of shares. In this case, the outstanding shares. Earnings per share represents how much money a company is making for each share of a stock. Okay, I'll take you through how to identify all the items and able to come out with the earnings per share. So we are seeing total earnings. Okay, we'll show you how to identify it in the company financials, and how to identify the outstanding shares. Okay. Number 2, we have the expected growth rate. This is the anticipated rate at which a company's earnings per share is expected to grow in the future. It's an estimate of how fast the company's profits will increase. Okay, so we'll also look into detail how this is also done. And we have the P ratio. This is widely used by many analysts. P ratio is the current market price of a share divided by the earnings per share. Okay, it represents how much investors are willing to pay for each dollar. So in our case, it's going to be CD of earnings. A high P ratio typically indicates that investors have high expectations for growth, for future growth, while a low P ratio suggests lower growth expectations. Now we look at the breakdown. So kindly take a few seconds to look at how the details of this is. So as I mentioned in the formula, the intrinsic value, earnings per share, multiplied by into brackets 1 plus R meaning the growth rate times the P ratio. So this is the breakdown. This part calculates the expected future earnings per share. It takes the current earnings per share and projects it into the future, considering the expected growth rate, R. So if the current earnings per share is 2 and the expected growth rate is 5, this part calculates the EPS 1 year from now should be 2. That's the formula there. So 2 times into brackets 1 plus 0 0.505. So the value you come out with is 2.10. All right. Still, don't panic. We're going to go into detail. All right. We're just warming up into it. Okay. We prefer that you go into the practicality of the whole thing. This stuff, this is a theoretical aspect. I just want to warm you into it. All right. So P ratio, this is the price to earnings ratio, which represents how much investors are willing to pay for each dollar of earnings. For example, if the P ratio is 15, it means investors are willing to pay $15 for every dollar of earnings. So the formula combines the components to estimate the intrinsic value of the stock. All right, so it calculates the expected future earnings. That is the formula there, and then multiplies it by the P ratio to determine what the stock should be worth based on the earnings and expected growth rate. So investors often use this formula to assess whether a stock is undervalued or overvalued compared to the intrinsic value. So if the calculated intrinsic value is higher than the current market price, it suggests that the stock may be undervalued and could be potentially be an attractive investment. However, it is essential that you consider other factors. All right. So after you come out with your figure, you compare what you have with the market price. Then again, I'm going to show you how to identify the market price on the GSC base. Let's take a second to look at this page too. All right, so the next formula we're going to look at, or the third option to use, is an asset-based valuation to calculate the stock's intrinsic value. So the intrinsic value, Mr. Man? Kindly let me just finish. Write your question down so that when we are done, you ask your questions. Okay. So the intrinsic value formula for this method is perhaps the simplest of the three. So identify the company's total assets and you identify the company's total liabilities. You take the liabilities from the assets, and that is what we call the intrinsic value. In our case, we're going to divide this value with our outstanding shares. All right. So that would be the book value per share. So when you take out assets, or take out liabilities from the assets in our books or in the financial statement, you see that it is total equity. That's what you see in the financial statement. All right. It is also called the book value, and it can also be termed the intrinsic value. What I'm saying is that you identify the outstanding shares, then you divide the value you get by the outstanding shares. So the figure you're going to get is the book value per share or the equity holding per share. right? Here is what each component means. So the total, as I said, is these are the valuable resources owned by the company. Assets can include cash, buildings, equipment, inventory, investments, and more. Assets are what the company owns and uses to generate income. Normally, that's what we say. You are an asset to this company. That means you help this company to make a lot of income, right? However, when you are told you are a liability to this company, you must know that you are not producing or you're not adding any value to the business. So that is the simplest example I can give you. So liabilities, these are companies' debts or obligations. Liability can include loans, bonds, unpaid bills, and any financial commitment the company owes to others. Liabilities represent the claims others have on the company's resources. Now the formula, let's break it down. So companies are said the total value of the assets of the company possesses. It represents the company's economic resources. Company liabilities is the total value of all the debts and obligations the company owes. So in this context, intrinsic value represents what the company would be worth if it were to be liquidated, meaning if all the assets were sold and the proceeds were used to pay off its debts and liabilities. All right. So in other words, it is the net worth of the company, the value that would remain for shareholders after settling all the company's obligations. Investors and analysts sometimes use these calculations to get a sense of company's financial health. Okay, and it's a potential value in the worst case scenario. So if the intrinsic value is significantly higher than the company's market capitalization or the total value of the outstanding shares, it might suggest that the company is undervalued. So these are the two formulas that we are looking at, but we'll also take a look at PE ratio. So PE ratio, this is also a breakdown of what PE ratio is. Okay, so this is an example that I came out, very simple example. So imagine you are considering buying shares in Bank, all right, and the price of one share is 10 cedis. The price P is 10, which is how much you pay to buy one Bank share. The earnings of the company is like the profits, as I mentioned, the bank makes in a year, okay, which is 1 Ghana cedi per share. Now let's calculate the P ratio for Bank. So P ratio, price of one share divided by the earnings per share. 10/1. P ratio is 10. All right, so the P ratio for Cal is 10. Now, what does this P ratio mean for Bank? A P ratio of 10 means that for every 1 Ghana cedi of profit or earnings, Bank makes per share, you are paying 10 cedis to buy one share of the bank. Think of it this way. So if you bought one share of Bank, it is kept and it kept making 1 cedi in every profit every year. It would take you 10 years to earn back the 10 cedis you paid for. So assuming the profits remain the same. Okay, so this is the breakdown. So the PE of 10 means that out of every 1 cedi of profit Bank makes per share, you are paying 10 cedis to buy one share of the bank. So you can take a second to also look at this page so that we continue. So let's move on. So a high P ratio might, let's not go into too much, otherwise we won't be able to. This document actually will be shared to all those who fully register for the stock pitch competition. So I wouldn't want to go into too much detail of these narratives. So earnings per share. So it's like, yeah, this is also a very simple analogy that I made. So the formula is the total annual profit divided by the number of shares. That's the outstanding shares. Okay. And these are also detailed explanation of the earnings per share. We have explanation of the book value too here. We have the hand details here. So let me just go straight to the Excel we've been working in so that we understand how to go about it. So as we've been using all this while, these are data of all the banks. Okay, so I'll click on this valuation sheet. As I said, it's very, very simple. Okay, so for every financial statement that you see, most of them come with the earnings per share figures. Okay, so for Cowbank, these are the earnings per share figures. 0.27 for Q2 2019, Q2 2020, 0.25, 0.33, 0.40, and 0.32. These are the figures. Okay, so we put the earnings per share. So it's quite easy to do this in Excel. Right. So when you put these figures in Excel, it's very easy. You will find it very easy for you. So we'll put our earnings per share. The last earnings per share figure, that's 0.32. Okay. And the growth rate over the period, that is what has happened in the past. Okay. So these are the growth rates calculated here. So I'm going to go through it too. So I think in the last meetings, I mentioned that in calculating these figures, you need to compare the current figure with the previous figure. Okay, so in this comparison, it is what has happened today, present. You take out what happened yesterday and divide it by what happened yesterday and multiply by 100. Okay, so this is what we have gotten here. Okay. This is also another formula, but I mean, just go by what I said. That is the simplest approach you can get. Okay, I think this, all right. So in this case, we compare 2020 to 2019. For this figure, 29.82%, we compare 2021 to 2020. For this 2022, we compare 2021 and 2022. And for Q3 2023, we compare 2023 to 2022. So these are the figures as we can see here. All right. So with this, you pick the average return of these figures. That will be the return that you're going to put here. Okay, so this R represent the average return over the period, average growth rate over the period. Okay, so when you highlight it, you can see from the screen that 6.98 is shown here. However, you can also put in a formula to come by your figure. So the average, this is the formula. So you type in average. Let me just do it here again for you to see. So AVARAGE, you type it there. All right, then you highlight these figures. You close the brackets, then you enter. So the average growth rate is 6.98%. So you put your figure there. Okay. Then the price per share is what is happening on the market currently. So on the market is 61 pesos per share. You can go to the website that I made mention of in our previous discussion. So this is afskoiksi.org. The price of Cowbank, when you scroll down, you can easily see it there. Price. Okay, so that's the close. So 60 pesos per share. So I'm going to pick this figure. So 0.60. Okay. Then a PE ratio, that's the price per share over the earnings per share. So this is also quite straightforward. So what is the price per share? That is 60 divided by earnings per share, the last earnings per share figure. All right. Then you put it there. That is 1.86. All right. So you can see that the 1.86 is also shown there. So we're trying to get all the figures to calculate this intrinsic value. All right. So now we have our earnings per share, we know our growth rate, and we know our PE ratio. Okay, so we can put them here. So we multiply all three. Earnings per share multiplied by the growth rate. I'm going to come to the detail of this growth rate. Yes, hold on. And the P ratio. There's the P ratio. Now you enter. So this is your interesting value. Very straightforward. For this growth rate, this is the formula for finding the average growth rate. Okay, so it's 1 plus the growth rate as you have recorded on the average calculation. So 1 plus 0.0698. Okay, so that is the formula. So that is what is being shown there. So the only technical part is that the R is the average of the growth rates or the growths as recorded over the period. All right, you find the average, you put it there. The rest of the information are quite straightforward. For this is your intrinsic value. So you compare it to the share price. As you can see, the close price is 60 pesos. So with this, you can easily say that this stock is undervalued and it is a strong buy. All right, because the intrinsic value, the fair value, is above what the market is recording. Okay, let's move straight to the second formula, which is also very straightforward. So with this formula, that you have a total asset, total liabilities. With this total assets, you pick what you have collated with your bank data. So as I said, they are all in the financial reports. They are all in the financial reports. So you go and identify total assets. These are the total assets and the total liabilities. Okay. So we can see here that total asset is 9.5 billion. Total liabilities 8.9 million. So we'll go back to analysis sheet. That's the figures I've put there, 9.5 billion and 8.9 million. Okay, so the book value here, this is what it will be. So that means we take away the liabilities from the assets to get this figure. The outstanding shares is also can be found on the same website as I showed you. So outstanding shares, when you scroll down, outstanding shares figure is here. Okay, you can also get same on the GSC website. We'll go on the GSC website. Okay, that's so these are the figures that you, but I want to urge that you do some probes before you pick them. So that's the outstanding shares. So with this, the book value per share, as I mentioned, the intrinsic value will be the assets minus the liabilities. So with this formula, this will be the book value. 597,591. Okay, but however, we want to compare the share price. So we have to divide it by the outstanding shares. So in doing that calculation, so it's going to be, let me just do it here again. The book value, as you can see here, divided by the outstanding shares. And that is the figure we have there. So this is the intrinsic value. All right, for stock page competition, this is the approach that we recommend for all of you. It is very simple and straightforward. All you need to know is to be able to identify your figures from the financial analysis. Okay, let me see whether I have the... Okay, so we have this is a car bank financials. So so as I said, you just pick the figures from the financials. So we pick this total assets, total 8.9. Then this is the book value. Okay, because you want to know the book value per share, you divide this figure by the outstanding shares, and that is your book value per share. So with this approach too, you compare this with the with what is being recorded on the market, which is 61 pesos, as we saw here. 61, that's a 60%, sure, 60 pesos. So and then again, you can tell that the market is way trading below what the intrinsic value is. So basically, this is the calculation, this is the formula, this is the approach to the valuation. It is quite straightforward. It is quite very simple. as I said again, this is the basic way, and this is what we recommend for all participants of the stock pitch. If when you understand the finance proper, there are other methodologies that you can attach. So in our case, this is the basic approach. This is the simplest way to identify or to value your company. So this comes to the end of the presentation. I'll pause for questions. It took just 9 minutes, 10 seconds. So I'll pause for questions. Isaac Asamoah, can we have your question?
Good evening, sir.
Good evening.
Please, the outstanding shares, 627,000. You know, when you go to the balance, financial position, the equity, we know the components. But how do we get that 627,000 as the outstanding shares or the number of shares?
Okay, so let me just go to the GSC website.
Uh-huh.
Let me start. Let's hold on. When you look at this, it is what 627 million.
Okay.
This is 27 million. However, it
Okay.
is in thousands here because I mentioned this is 9 billion, but
Okay.
it's been cut to what million? And this one too has been cut
Okay.
to million. All right.
Okay.
So
Yes, sir.
in the same way, this one also has to cut into the thousands. All right.
Okay.
To get
Okay.
the correct value. So that is the explanation to it.
Thank you, sir.
You're welcome. Any other? Okay, so Robert, in council, please, can I have your question? Can I ask your question?
Yeah, hello, sir. Good evening.
Good evening.
Concerning to the registration, that we are like, if you're a group or you are going as an individual, you're supposed to pay. How will that be followed up?
Can you ask the question again?
I said concerning the registration where we are supposed to pay and register, and how will that be done?
So are you part of any of the platforms?
Yeah. I was added to a platform, but the lady there said like each if even if you're a group, you're supposed to register individually.
Yes, that is the case. You're supposed to register
Okay.
individually. So when you register,
Okay.
you can ask for the presentation so that to be sent to you. Okay. Yes, ask for my
Okay.
number, I'll forward it to you. Just show
Okay.
evidence that you have paid. That's it.
Okay. All right.
Uh-huh.
Thank you.
You're welcome. Any more questions? Robert again? Okay, Robert is out. Any more questions, please?
Please, with the valuation,
Mhm.
with the business valuation, what are the keynotes? What are the things we should be mindful of?
Okay, so basically they are the stuff that I have mentioned. So with this approach, if you want to use this approach as in the financial metric analysis approach, you have to ensure that you are getting the average growth, EPS growth, like correctly. Once you get these figures wrong, everything will be wrong. But I keep mentioning that it is important that you take note of the data that you have collected. Okay, if the data is wrong, you may be off. You'll be very thrown off. Right? In this analysis, you realize that this intrinsic value is 64 pesos and this is 95 pesos. Okay, it's not very wide apart. In case the data was very different, it's possible it could have been maybe you get 2 CDs or something. All right, so make sure your data you've collected is correct. But the rest of the information, this asset-based valuation model, they are all quite straightforward. Make sure your figures are pegged right and the answers will also be correct. But the main thing is to be able to defend the approach that you have used. You can combine the two approaches to make your point, but make sure you're able to speak to it like very professional. I hope I've answered your question.
Yeah, yes, please, you have. Thank you.
Any more questions? Okay, so these are the slides. Okay, so if there are no more questions, then I guess today's session would be the shortest that we've had so far. Next week, we'll have the final session where we'll just go through all that we have, to be a summary of everything that we've gone through, a summary from the beginning till today, or what you should end your stock pitch with. So Stephen says, is the valuation the only way to determine whether to buy, hold on, sell shares? Yes. That's the only approach. Okay, but there are some investors who do not even look at the price or the value. Some people just have the edge to get into a business. Sometimes you realize that the company's way, the analysis portrays that the company, or as is being shown on the stock market, is way overpriced. However, due to some personal reasons, they still want to go into it. Sometimes people want to take over a business. It doesn't happen within a day. So they'll be buying it, whatever the price, they'll be buying it gradually until they achieve their purpose. So for a rational investor, or an investor who wants to earn returns on investments, this is the best approach that you can go with to in order to buy a share or to sell your share. Any other question? Okay, so thank you so much for your time. Kindly make sure you register for the stock pitch competition. It's happening live. You'll be contacted. I mean, the team are in place. You'll be contacted. And as soon as you register, make sure you contact me for your slides. Thank you very much. See you guys next week. Bye-bye.